I say this with a lot of certainty that there will be at least one multi-trillion-dollar company that comes out of this wave, perhaps even multiple.
I'm really excited to welcome here our very famous Peter Walker and our incredible guest, Janelle Teng from Bessemer Venture. So give him a warm welcome applause. Thank you.
Hey everyone, my name is Peter. I run the insights team at Carta. I've probably invaded one or more of your LinkedIn feeds over the last year. Hopefully the data that we've been putting out is useful, but the data is just one side of this conversation. The other is when you get to hear from fantastic people like Janelle about what's really going on when you're trying to fundraise as an AI startup today. So, show of hands. Who among you is building an AI startup? All right, who is not building an AI startup? Okay, earmuffs for the next hour. This is gonna be tough. Janelle, I'm gonna just whip through a couple of data slides here, but jump in whenever anything feels interesting or useful, or when you have wonderful perspective to add. This, I think, is the biggest question that's been going on in San Francisco, across startups since, let's call it, beginning of 2023, which is what the hell is going on? How different is startup building today than it was a year ago, 2 years ago, 5 years ago? Because it feels like we are running at a dead sprint and we still can't keep up with all the changes. So first and foremost, if you want these slides, I'm not going to gatekeep them. You can download them right now for free because you're all here. That's a gift. I'm going to take a break. And that was the talk. Wonderful. Good to see you all. This has been so fun. Okay. Don't worry if you didn't get it. We'll do it again at the end. So first things first, I think it's useful to situate the current moment in some context because it can feel like today is the only day that's ever happened. But actually, in terms of sheer insanity, 2021 was actually probably even crazier than right now, outside of unless you work at OpenAI. $220 billion invested that year into Carta startups, which is absurd. And then you can see 22, 23 was a real winter. And we always sort of benchmark to the last peak. So that decline felt even worse than it actually was. I don't know, how did it feel at Bessemer during those two down years?
Yeah, I would say a huge part of this fundraise, especially pre-2022. And 2022 is a monumental year because ChatGPT was launched at the end of that year. So that's how I would kind of split the fundraising environment: pre-ChatGPT, post-ChatGPT. Pre-ChatGPT, a lot of that bulk of the money actually went into foundation models. So if we were to maybe break this down into what went into applications, what went into foundation models, what went into AI infrastructure, I would bet that over 50% of pre-ChatGPT, if you will, funding did go into foundation model companies. Yep. So that was all the rage at that time. And some would say, as we enter the post-ChatGPT era now, that a lot of that foundational money that has gone into these model companies should start to taper off. And actually, I'm of the view that we're just ramping up. So there's a first wave of AI infrastructure money fundraising that went into these foundation model companies. We're now going to see a second wave that's more about things in AI infrastructure like evaluations, like reinforcement gyms, compound systems. So there'll be a new wave now of funding into AI infrastructure for the second act. And I think the story is not quite done yet, basically.
That's very exciting. We're back on an uphill wave. Yes. You know, it does strike me as difficult for the companies that were founded just before the ChatGPT moment, who didn't maybe get the advantage of building in an AI native way. Maybe we'll talk about those in a little bit. But for those of you in the audience, as founders, I think one of the biggest questions that you will face is not just how much money will I need to raise in order to make this company work, but at what cadence do I need to raise it? How long should I expect the cash that I'm raising tomorrow to last me? And again, here we can show some medians like this where, between rounds, the time has risen at every single one of these stages. So if you used to plan that you were going to fundraise every 18 months, that's probably planning to fail these days, unless you are part of a select cohort that can fundraise every 6 months if they choose to. It's a tale of two cities, have and have-nots. And I wonder if, what kind of advice are you giving founders on, okay, we raised a round in the last month. How much time do you think that gives us?
Yeah, I think it's so hard to balance this because things are progressing so quickly. So you do want to be investing in growth and in things that work. We kind of say nail it before you scale it. If you find something that is nailing it, like a distribution channel that's working, you do want to fuel and accelerate because now is the time. But at the same time, at Bessemer, we very much believe that growth needs to be what we call efficient growth. So you do need to match that with your burn. How we like to look at it is your net new ARR to your net burn, and you try to keep that. Even as fast growing startups, you want to try to keep that as close to 1 as possible. But again, it's more of a ratio. We don't look at it in absolute terms. So yes, if you found something that works, that you want to pour fuel on the fire on, we will support you in that. And you should go, raise money to work on that strategy. But if you haven't experimented, maybe that channel is not working as well, you should not be kind of throwing all your eggs in one basket. So that's how I would see it on a relative basis. And it's hard, it's not so much the absolute dollar amount.
Totally. I think that makes a ton of sense. It actually gets into this question around, oftentimes founders come to me and they ask, look, I kind of have an idea of what I want to build and how the way that I would like this company to grow. But what do I need to do in order to be attractive to venture at the stage that I'm at? And one of the things I think founders do a little too infrequently is think from the VC perspective. So if you're thinking from the VC perspective, imagine instead of being a founder, you ran a fund and you invested in a ton of seed stage startups. This is the graduation rate of those startups. So it's a little bit of a complex chart. But if you focus on the x-axis, that's when did I raise my seed round? And then the y is just how long did it take me to raise a Series A? So if we just focus here, there was a quarter of 2020 where 40% of companies that raised the seed round got to Series A in 2 years or less. That green slice right there. That is a lot of companies. 4 out of 10 companies making it to Series A that quickly is like, it's too fast. It means we have too much money. It means it's not hard enough probably. Well, it got a lot harder for those of you that we're building right now. So right now we're seeing between 15 and 18% of companies that can get from seed to A in 2 years or less. So while you're reading about all those headlines of those companies that are raising every 8 months, and it seems like at extraordinary valuations, just know, again, that is not the entirety of this market. And there are companies that are building at a slightly slower growth pace and taking more normal, quote unquote, times to get this kind of acceleration done. So let's bring in AI to this conversation because that's why we're here. First things first. This is one way to look at this chart. I actually kind of prefer this one. AI is just increasingly dominating the share of all capital invested into startups, no matter if you're a seed stage or late stage. My question for you is, does this have a natural endpoint? Or are we just going to stop talking about AI and we're just going to say, we don't talk about JavaScript companies. We assume if you're building software, you're using AI, and we're not going to call it its own sector.
Yeah, I think AI will permeate everything. How we kind of see the universe, you have AI native companies. So these were maybe founded, kind of the last post-ChatGPT, if you will, like in the last 3 years. But a lot of our SaaS companies, if you will, just regular vanilla software companies are now embedding AI. And a lot of them are seeing a second growth curve within that. Even our cyber companies, because AI is a new kind of surface for attacks, they're seeing a new growth curve by kind of investing in AI offerings and strategies. So I think AI will, what is an AI company? It's really hard to say when you have AI in your workflows, in your offerings. So I think at the end of the day, how we kind of see it is, are you leveraging AI to grow your startup? That's kind of how we view the world. And there are AI native companies, but there are also AI embedded companies that can do as well as the AI native.
So there's would you say that there is a prejudice is perhaps the wrong word, but a preference for AI native versus AI enabled? Or is that really distinction not actually made within the fund?
I would say it's more about the numbers and the data. Because again, a lot of our kind of incumbent, if you will, companies that were in the SaaS era, they are embedding AI and then also growing very, very triple digit growth at, kind of growth stage growth stage timelines, which
right.
Not, very, very unprecedented, not seen at least in the SaaS wave of companies.
100%. And so again, you just answered the question that most founders ask me, which is, Peter, how do you define AI and all this data and is this good, et cetera? I have a bad answer to that question, which is I ask you, the founders, are you an AI company? And you tell me. Do you agree with your fellow founders? No? Okay, cool. Not very trusting of the room, but it's when you break it out into valuations and this affects all these metrics that we're going to go through, So if you're raising a seed round today, median seed round valuations, this is pre-money. So if you want a post-money valuation, and again, post-money is usually the one you read about in TechCrunch and everything, you add the cash to the pre-money, right? So if you have 15 and a half at the AI valuation for seed stage, you add in about 3.5 raised, you're talking about a $19, $20 million post-money company. That's at the seed stage right now. In San Francisco, actually, it's probably a little higher than that. Maybe quite a bit higher.
I was going to say, if these numbers look great as an investor, if I could invest it. That was
Janelle promises that if you come to her with a deal of this size, she will invest in it today. So congrats. That's an offer, by the way. That's an offer from all of us. Unexpected. The weird part about this one is that black line, the non-AI companies, is actually pretty close. And that struck me as odd because at every other stage, Series A, Series B, et cetera, it's not. There's a very big gap. What I think is happening at seed is that in order to raise as a non-AI seed company, you have to be so fantastic that you're getting the growth anyways. You're getting the multiples anyways because you're one of a very, very select few that is raising. But this same valuation distinction between AI and not AI, no matter what part of venture you're looking at, there's an AI premium being applied. You already spoke about this a little bit, but when I talk to other investors, sometimes the distinctions between application layer and infrastructure layer or AI enabled and AI native come up as like reasons to be slightly skeptical about this. So I'm wondering, are there really, really large gaps still between an infrastructure AI company and an application layer AI company?
I would say yes. So I focus on working with highly technical founders, and a lot of my portfolio, the AI portfolio at least, they are building in AI infrastructure. There is just different unit economics for AI infrastructure companies. There's compute costs if you're building your own model. If you're integrating in a certain way, there's also forward deployed kind of resources that you may need versus applications. A lot of times, you're truly selling software in a way and can use kind of the SaaS playbook to sell your offering. I fundamentally think there are differences. And if you look at just, again, harking back to the SaaS era, data infrastructure companies like Snowflake, Databricks, they have very different economics and delivery models from some of the more vertical application companies. And so that's how I would kind of view the world. You have your AI app companies and AI infrastructure companies. Both can be growing at really, really fantastic rates, but all have different COGS and implementation models that will feed into the unit economics.
Gotcha. And do you find that investors, at least the ones that you talk to and respect, are focused on one or the other, or are people playing across both?
I think people play across both. It's also, based on, your interests and the way your fund is structured as well. Again, I love working with highly technical founders, a lot who do come from academic backgrounds, research backgrounds, and just based on their interests and passion, they do tend to be building in highly frontier infrastructure spaces.
Definitely. All right. So I got to be honest, I don't usually show a lot of data that's not Carta data because I'm very selfish. But Janelle and her team put out a fantastic report on how AI, the new benchmarks of AI recently. So this is from Bessemer, and it's something you can download right after this. But the distinction here between supernovas on the one side and shooting stars, why don't you take us through these two different kinds of AI builders?
Yeah, so just to set some context here, Bessemer has benchmarks are not, they're quite an imperfect way to judge startups, right? Everyone has a different story. But what we do at Bessemer, we do like to aggregate data, and we have done for many years now. So we have SaaS benchmarks that we've now compared to our AI benchmarks. And just to give some context, in the SaaS world, if you are a fast growing, like highly valued SaaS company, it would take you on average about 7 years to hit the 100 million ARR mark. Yeah, this is a great graph.
That's the cloud centaur.
Exactly. And mind you, the cloud centaurs are fantastic companies. These are not laggards in any way, shape, or form. It did take 7 years to kind of hit that 100 million annual recurring revenue. So we are considering recurring revenue only, not services and things that are reoccurring, so to speak. So it took 7 years, and that was a really strong benchmark. And AI, to the opening, has completely changed benchmarks on its head. Like truly, companies are growing at very, very unprecedented rates. And so we have one set of AI companies that we're calling Supernovas that are hitting that 100 million ARR mark from 2 years of inception, typically. So that is extremely, extremely fast growth.
Wow.
And then there's another set that we call shooting stars that are also still hitting the 100 million ARR mark in record time, so about closer to 4 years. And the main difference here, back to that table and kind of the other graph, is that if you look at margins, I kind of argue that top line numbers, headline numbers can be very misleading.
What?
Yeah, exactly. Even though you read the newspaper articles,
That's not what I
this is
heard.
the huge headline number. I would say not all growth is the same. For me, at least personally, when I look at growth, like I really want to understand sustainability of it, efficiency of it, back to the point of how much did you burn to actually get there. Sustainability, I kind of think about it more from a retention perspective. So there are a lot of very fast growing companies, even in the SaaS world, that have a leaky bucket problem, right? Like for every 1 million they're adding, they're losing, half of that within the month. So you always need to patch back the lost retention, if you will, and the churn. And also another thing that's been a huge hot button topic has been gross margins. And if you do look at the Supernovas, again, these are the fastest growing AI companies. A lot of them do have relatively low margins. You'll see the little asterisk there. Said
Very
that
small tech.
gross margins can be negative for Supernovas. And I would say the shooting stars have a bit more of a sustainable margin profile. So you're looking at about 60%, which is not as high as, back to SaaS margins, 80%-ish, but 60%, I think at scale, you can build a fairly, wonderful business on that kind of margin profile.
So there's so many things about this that strike me as interesting. The first one is when you're looking at a supernova company or a company that you think has the potential to become a supernova.
Yes.
Judging things like gross margin or repeatability or sustainability of revenue for a company that is literally 18 months old has to be incredibly difficult. So is that one of the reasons why people seem to be defaulting to, look, faster growth is better, and we're just going to fund this fast growth, and we're not going to be as worried about a leaky bucket problem, because a leaky bucket at $125 million in ARR in 2 years is not the same as a leaky bucket at $20 million of ARR?
I think so. Retention, I would say margins, I would put aside for all, and we can address that issue, because I have a lot of comfort as an infrastructure investor investing in gross margin negative businesses at the kind of earliest stages. Retention, I think, is table stakes, because that is a really hard bucket that you need to fill. And retention doesn't. I think retention is just an endemic of certain things in the business model or the market. So, for instance, there might be very low switching costs that are inherent in the market, and maybe you can get comfortable with that if you think the market's like large enough where you can churn through a large percentage and still have a great customer base. So there are exceptions to that. I would say retention is a tough one to overcome if you're kind of really showing that leaky bucket problem. Another reason for churn is that a lot of enterprise budgets, especially in the 2022-2023 period, were like innovation budgets. Like these were not software that was going to production. These were one-time R&D kind of efforts to incorporate AI. And they were more experimental in nature. Yep. And so the quality of that revenue is not recurring by nature. Right. And so I do think you need to account for that quality when coming up with valuations or deciding to invest in a company. Gross margins, I find a completely different situation. I think with gross margins, if you have a short-term view on gross margins, you can miss the biggest winners. Like you need to think about what gross margins might look at scale. And to give you examples from pre-AI era, as a data infrastructure investor, it was very common for some of the largest data infrastructure companies today, say Snowflake. Snowflake was gross margin negative up till growth stages. So not let alone, seed and Series A stages. And there are a lot of very, very reasonable reasons for that to happen. And I think as an investor, you need to have a long-term view of, can you believe that over time, these margins can improve to sustainable levels? And there are many plausible reasons to believe that in the AI world. So for instance, if your business model is very dependent on compute or hosting costs or even model API costs, how much can that fall as COGS in order to regain margin? There are companies that are exploring vertical integration in order to have margin improvement. Is that a feasible strategy? I would say in certain cases, yes. And you, as an investor, you need to understand that there are a lot of things going on in tech and infrastructure that you can improve to boost margins. So for instance, like there's some companies that are routing workloads to more smaller or more efficient models. So that way you're not just like kind of having one size fit all model that's very expensive for all your workloads.
Right.
Some are exploring specialized hardware to help them run loads more efficiently. Even optimize infrastructure. There's engineering work you can do. For some app companies in our portfolio, if there's a human in the loop, say to do quality assurance on your AI, at what point can AI just become so powerful enough where you can reduce that human in the loop cost? So I would say there are pricing levers as well as you get to scale. Can you do you have more leverage in negotiations for contracts, but at the same time, can you put in more pricing discipline, discount discipline to boost margins? So I think gross margins is like almost you really do need to do diligence to kind of figure out whether you can believe in the long-term.
And it's so depending on the business model as well. Whereas that Snowflake example that you gave, I bet their NDR was fantastic in year one, as opposed to them burning money on stuff. So this strikes me, the last part of this table that is so interesting is the revenue per full-time employee metric. And by the way, if you're a founder out there and you're thinking, what is a VC going to ask me during this meeting? You should know that number by heart, right? You should be able to repeat it and know exactly when it changes. So how many full-time employees do you have and how much revenue do each of them generate? An old great benchmark for, like at scale, great company might have been $300,000, $400,000 per employee. And now we see AI companies running at 1 million, 1.5 million, et cetera. When you're looking at the team size, is that something, what level of capital efficiency or the team size efficiency are you actually looking for? Is it more just kind of on a business by business basis?
Yeah, we do look, again, I do like efficiency metrics that take into account kind of all of the business, if you will. This is just one nuance of efficiency, but I still like kind of net new ARR to net burn, gives you a kind of higher view instead of zooming in on just margins, just variable costs, just ARR by FTE. But I think what this shows is that AI founders are extremely efficient and scrappy in ways that I think we even as VCs, we're very, very surprised by. I think as startup founders, there's always that DNA to be very resourceful, very, very strategic in how you're spending resources because there's a limited pool of money or talent, and talent is very expensive in today's AI age. And so companies, startups really get creative in how they incorporate, AI in their coding workflows, AI in customer service. So AI founders are kind of eating their own dog food, if you will, and leveraging their own products or other AI native products into their own company to get it more efficient.
So if I'm a founder out there and it feels like the narrative has sort of run away from me, right? So I look at myself and I'm pretty honest and I go, look, I'm not a Supernova right now. I'm not managing that company because it's been 18 months and I don't have $100 million in revenue. So it was a pretty easy check. But maybe I'm a shooting star. Maybe I'm in between a shooting star and a cloud center. I sure as hell, if had been raising 5 years ago, would have gotten a ton of interest from VCs, but I'm just not feeling it now. What advice do you have to founders in that situation?
I would say, again, benchmarks are such an imperfect way of measuring a startup's progress. If you, again, this doesn't tell you how much was burnt, right? Correct. Like things like that. Headline numbers can be misleading. What I will say is that, in the past world or paradigm, SaaS world, you guys might have heard triple, double, double was kind of the golden standard, if you will. So if you're a SaaS startup, you want to be tripling in your first 2 years and then doubling into kind of the years after. And that will get you to that 7 years, 100 million ARR.
And that's a revenue metric.
A revenue metric, growth metric.
Yep.
I think a lot of the narrative has now, because of the Supernovas and shooting stars, has moved towards like quadrupling in your first 2 years and then tripling from there. And mind you, we're not, again, ChatGPT moment really happened at the end of 2022. So using that as our kind of milestone year, if you will, we're not at 5 years, so to speak, from there. But I think a lot of the narrative has moved to say, like, I want to be funding these super high growth fast growth companies from a headline value. But I would say as a founder, it's so important to think about efficiency against sustainability that we talked about. And you will find the VC that aligns with you in that philosophy. And when you do, I think then it's a fit that way. So I would say if you're not, on this path of like quadrupling, don't try and, do unnatural things and force your company into that. Like think about efficiency, think about sustainability, and that can be your narrative going into pitches. And there will be, even within Bessemer, like there are VCs that really, really buy that narrative and love that narrative and want to support companies that maybe take 7 years to, again, 7 years is a great benchmark. So I don't know what we're talking about, like it's,
Right.
like it's a bad company. That's a best in class benchmark for SaaS. So I would say even getting there in 7 years, you have built a terrific, sustainable company.
100%. Yeah. Scroll past, probably log off of X for a little bit.
So yeah, X
It's
is
like, don't spend time on X. Yeah, so that's just blanket advice. That doesn't apply to startups. That applies to life. But if you do end up going on there and you read all the headlines, or you're reading, the Harry Stebbings interview with the CEO of General Catalyst, Hema, sorry. It's okay.
Yeah.
Take a deep breath. There are people out there who are funding people who do not look like that. But the advice that you gave, which I think is important, is understand that about where you are, and probably don't spend time pitching people whose entire portfolio is made up only of supernovas, right? If you do not fit that benchmark. Right? Aligning yourself to investors who have the possibility to actually understand your worldview, understand your business, et cetera. I don't think it's always been important. It's never been more important now. I think there was a period pre-ChatGPT where it kind of felt like venture investors were all kind of interested in the same things. I think that's not true anymore. There are different people who specialize in different pockets. And so figuring out who they are, I wish all of them have websites as good as Bessemer's who can understand what they're looking for, but not all of them do. But it's important to go and find those people for sure. They're out there. By the way, if you want to download this report, I highly suggest it. It's an awesome report. State of AI 2025 from Bessemer, one of our favorite partners. Yeah, I think you're getting more downloads than I did.
Oh, hey,
It's
a contest.
No, it's never I mean, we're not tracking. We are tracking. Okay, so now we get to a little bit on what these dynamics mean for you as the founder. So this is some data on dilution through the company's life cycle. So even within this AI paradigm, even though you're reading these gigantic valuations, these round sizes have increased, the strange part is the dilution has remained kind of the same, right? So you're going to sell probably, give or take, 20% of your business in a seed round. And that's been that way for 6 or 7 years now, actually. And you're going to weirdly sell another 20% or so in the A round. That's a little bit grayed out right now, but you can't see it. So why is that the case? With all these different dynamics happening, why is it the case that this number doesn't change? Our take on this is that it's mostly because this is dictated by the needs of the fund rather than exclusively the needs of the founder. Meaning many funds have explicit ownership targets. They need to own a certain percent of your business in order to make it worth their while to be a fund returner for their fund down the road. And 20%, when you do all the math, is kind of where it nets out. 10 to 15% for the lead, 10 to 5% for the follow-ons and angels and everyone else filling out the round. One of the things that we've seen really explicitly through these rounds is that there are investors out there who, when they believe in a company, are just trying to take as much ownership in that company as they possibly can. I don't know if you're running into this more and more, but at least when we look at our data, there are lead investors who are saying, if I believe in you, I don't want 10%. I want to own 20% of your business or 25% of your business because I think you're so great and I'm willing to pay up for that amount of money. I don't know if you're seeing any dynamics change on dilutions when you go into deals.
Yeah, I would say how I look at it and how I advise my founders to look at it. Valuation is like a triangle. You're trying to triangulate. This is from the founder's perspective more than anything else. So there's that dilution component. There is the round size that you're raising, and round sizes have gone massive, especially in infrastructure. And they're huge reasons for that. Sometimes you want to have a war chest for acquisitions, or you want to be able to compute's very expensive, especially for companies. So you want to have a nice pool of funding for that. So it's dilution, round size, and then it's that kind of gives you the headline value, if you will. And then from an investor's perspective, what we're triangulating to is then you get the multiple of, however you want to value the company, multiple of gross profit, multiple of revenue.
Yeah.
And as everything pushes, if you keep dilution the same, everything else is moving up. That means the expectations of your company is also going up when that headline value goes up. And again, from the investor's perspective, keep dilution the same, round size goes up, that total value goes up, and the multiple that we're valuing you on, or the hurdle to raise your next round or grow in your valuation, gets higher and higher. So that's how I think founders like to think about it more. And I would say that the dilution remains the same for many macro structural reasons, certainly, but also the dilution stays the same because the round size is also going up. So they're getting compensated, if you will, for the same dilution.
100%.
But at the same time, it can be good or bad because the overall valuation of the company has also increased. And that, I kind of think about valuation as it is a hurdle, it's the expectation. You don't want to kind of get over your skis too quickly because it's going to make the next round harder to raise. It's going to make hiring a little bit harder too if you've raised over your skis and there's maybe a potential talent doesn't think there's as much upside anymore. So there are a lot of, I would say, think about it more from a framework of trying to triangulate all the different pieces.
I want to double down on something you said, which I love, which is valuation is a hurdle. Oftentimes we think of valuation as a badge of honor almost, or I hope this isn't true for all of you, but I have run into founders who think of it as their self-worth, not just their net worth, which is not great, but it is a hurdle. It is an expectation setting for the following rounds VCs. And the higher it is, the higher you have set. Though if you're on a track meet and you're trying to hurdle that next gate, you just push that gate much higher, the higher you take your valuation. Not to say you shouldn't, right? But just know that that is the world in which you're competing. So valuation is not just a tagline that you get to celebrate when you raise the round. It comes with inherent expectations down the road. So I know that sometimes founders get annoyed. They say, of course, VCs would say we shouldn't always take the highest valuation, right? Because it's better for their business. I'm here to tell you as not a VC, they're not lying to you there. That can be totally true. Again, you're going to run through this dilution matrix. You're going to sell portions of your company over time. I think this is sometimes surprising to founders, but I wanted to go through it for a second. This is just ownership over time for each individual stakeholder group. So look at that founding team. That's the orange bars at the bottom there. There are many companies on Carta who, after their Series A round, they own 36 to 40% of their own company. And you say, where the heck did that all go? Well, one, there's a lot of angels and pre-seed and safes that convert. Two, 20% and 20% is no joke in terms of dilution. And three, and this is the part that most people forget about, you're going to incentivize your employees with equity. And the pool takes up a portion of that. And oftentimes the pool plus the founder ownership gets you to about that 50% mark. But most people don't talk about the pool enough. So you are going to hopefully have some incredible employees alongside you on this journey. You want to incentivize them generously with equity because they are going to be incredibly important to your growth and to your culture. But you also have to take them into account when you're fundraising because this pool dynamics are going to come up again and again as you raise rounds. All right, so more fun stuff. How many of you are San Francisco founders, Bay Area founders? How many are in from out of town? Okay, earmuffs for this part, out of towners. There's really no place like the Bay when it comes to startup funding. So wherever you look, unless you look in biotech and then they're all the way down to second, the Bay has attracted over the past 12 months more capital in all of these areas than any other place, any other ecosystem in the US. And if you did this globally, the chart would look exactly the same. So we really are in this golden age in terms of capital investment into startups in the Bay Area. What do you think that's about? I mean, obviously there's sort of a path dependency here, decades of tech in the Bay. But there was a story in 22 or 23 that like, okay, we're going to establish a lot of little Silicon Valleys and there's not going to be one place for this.
So I've been in the Bay Area close to 15 years now, so a huge bull on the Bay Area Silicon Valley ecosystem. I think it's a very special ecosystem for a few reasons. And it's the confluence of all these reasons that I think kind of speaks to the data. One, incredible concentration of talent from academia, universities, Stanford, Berkeley, really, really smart top talent in the space. The second piece is, especially with AI and infrastructure in particular, again, where I focus on, a lot of the major labs are headquartered here. And I don't just mean like OpenAI and Anthropic, like Meta, like a lot of the other, Microsoft has kind of campuses here as well.
Yep.
So a lot of that, Amazon has campuses here as well. So a lot of the big labs, if you have researchers there, especially in AI kind of times, those are huge currency talent that people really, really want. And so a lot of the big labs are giving talent to startups. And the third piece is capital. I mean, with Sandhill and the whole VC community here, I think there are a lot of people who are willing to finance risk and take risk on startups.
Yep.
And so it's kind of the confluence of those three that I think makes the Bay Area so special. I do think internationally, like London has some of this too, with DeepMind, Oxford, Cambridge in the UK, and also a growing VC ecosystem. Canada, parts of Canada also certainly show some of this, but I do think you need kind of the three in some ratio to kind of have a pretty robust startup ecosystem.
100%. Couldn't have said it better. Plus, there is just an insane amount of people here who made their money in tech and are very interested in becoming angel investors, right? The pre-seed and angel capital part, at the very earliest part, I think is denser here than basically anywhere else I've ever been. I'm going to spend the last 5 minutes here just running through some quick stats on AI company building, so team sizes, et cetera. But note, keep thinking of your questions because we're going to have a Q&A right after this with Janelle. The first, maybe the biggest thing that's changed when we look at startups on Carta over the last, call it 6-7 years, is just the wild lack of hiring that is happening right now. So just look at that black line. That's new hires per month by Carta startups. Full-time equity holding employees. So in the first month in January of 2022, startups on Carta hired 73,000 people. In January 2025, that number was 28,000 people. Now, part of this is because we way overhired in 21. I think that's pretty clear. But as we get further and further away from that peak, and as funding goes up and up, usually as funding increases, hiring increases. Those two lines are basically tied together. Right now, they're coming apart a little bit. And so there is this focus, whether it's ARR per FTE or capital efficiency, or, hey, we just like building with a small team and everyone enabled with AI tooling can do more. I think that this lean team era is real. And so as you're thinking of building your startups, I want you to keep that in mind as something that is kind of the current meta around building companies. And that applies to your very first hire, just as it will apply to your 100th hire. So this is data about when do you hire your first employee, your first non-founder, full-time equity holding employee. Used to be maybe half a year in, year and a half, or about a year. Now, on average, it's well over a year for many startups. And then their second and third hires are later still. So this means two things. One, you're building more diligently. That first hire is being scrutinized. Two, you better be building with people you trust on your co-founding team, right? There is no more important judgment that you can make than who are you building this startup with as your co-founders. How many of you are solo founders, by the way? Great. A growing percentage, part of the wave. I hope you've read the stuff we put out on solo founders. We have a lot more of that coming. And then the last point is just these team sizes, take all that data, you throw it into a team size graph and it looks like this, right? Hey, it used to be 20, 23, 24 people at a Series A company. Now it might be 16. By the end of the year, it might be 14. Again, small teams moving quickly is sort of the name of the game around startups. It makes me a little sad because I want more people to have opportunity to join amazing businesses, but it also means that the talent bar of these places is insanely high right now. So you're building with very, very good people.
And also the data, I know this is related to startups, but I just saw a graph today, more from public markets, where the last year or two, typically S&P as it goes up, jobs also kind of track kind of very, very closely correlated. This is the first year where there's an inverse correlation happening. So even in, beyond startups in the public markets, larger companies, you're also seeing some semblance of this trend.
100%. What the sad part, maybe sad, maybe exciting, if you're hiring right now as a startup founder, you might think, great, I will have my pick of the litter. Maybe true, but if you're hiring AI ML engineers, rough. Good luck. So look at that orange line. That's the percentage growth in the average equity package for an AI ML engineer over the last, call it 14 months or so. That's very high. Something going up like that 20, 30% a year is basically unprecedented. And of course, the salary is going up, not quite as much as the equity, because it's always easier to give more equity than it is more salary. But as you look for that amazing technical talent, it is at a high premium, not only because they have a lot of startups to join, but also because they are probably kind of interested in starting their own, many of them right now. So you got to convince them of two things. And that's really tough. I want to rip through these real quick. Thank you. These are takeaways from the Bessemer report. I wondered out of these, there's 10 key takeaways, but I wondered if there was one or two, Janelle, that really jumped out as you as like things you're seeing more and more these days.
Yeah, as an infra investor, again, I really do think number 2 is that next wave of where AI infrastructure second act is heading toward, and that will have impacts on application startups as well. In the first wave, it was about building models, proving that models could solve problems and, hit benchmarks. But the second wave of AI infrastructure is going to be very much focused on solving problems in the real world. And you need complex systems to do this. It's no longer, your primitive is not just the LLM and one model. You're going to have to build a whole ecosystem around that. And I think we're going to see some really exciting infrastructure companies come out of that. And then their innovations are going to fuel kind of new application innovations. Again, personalization, vertical AI. There's a huge wave coming that I think we barely scratched the surface on.
Yeah, it's really exciting. And today on OpenAI Dev Day as well, Agent Builder out in the world. What do you think of that phrase that comes around X, where it's like RIP 100 YC startups today?
I think so. What we always try to, even in infra, I think that apps certainly a huge hot button topic. In infra, what we always try to advise our founders is to think about any existential risk from the ecosystem players, and the risk is very real in infra. So like 3 years ago, there were a ton of companies that we're doing like specific techniques to improve the capabilities of an LLM. And these were literally call them technique companies. And they were monetizing their techniques. And those are really hard companies to try and survive any major changes within the base capabilities of the LLM. So when reasoning came out from OpenAI, a lot of those technique companies were kind of, just not necessary in the stack anymore. Or even if they were necessary, they were not the primary, their TAM kind of became smaller, so to speak. They weren't the primary technique for those workflows. So certainly the existential threat from some of these large labs that are now going vertically integrated. So not just building models anymore, not just building infra, they're building workflows, chat UIs, consumer apps on top of their models. Certainly something to think about. But I always say the best founders, I don't really like the word wrapper. Like I think you can almost every, what does a wrapper mean? You could put some really great workflows, some really great integrations around an element and have a great business. And that's a moat. So I think the best founders will always find ways to adapt to it. But yes, the existential threat, always need to keep that in mind, and be kind of 5 steps ahead, or give yourself some diversity in your product roadmap strategy in order to overcome any kind of threats that pop up that way.
Always got to be thinking.
Yeah.
So it's a fast pace these days, y'all. All right, questions. This is the same deck as before, the first one. So if you didn't get it that time, but who's got questions? Yes, sir. Shout it out, please. Oh, we have a mic. Never mind. Don't yell at us.
Thank you. Yeah. So when you're looking at TAM, I guess 2 parts. One, what is something that you've heard is like so outrageous, like over $1 trillion or something like that, where you're like, hey, this is ridiculous. It doesn't have to be $1 trillion or whatever. And then 2, as a founder, how do we realize this is the market that I'm looking for, or maybe I'm going too broad? So how as a founder, how do we kind of figure out what the right TAM is for us when there's so many different sources out there, and easy to convince yourself that it's 500 billion or whatever?
Yeah.
It needs to start with a T. You're right. Yeah, that's number 1. Yeah.
Crazy trillion-dollar TAM I've heard that's really out there, but actually it was like, really gave it a second take, and then I think it could be feasible. There are a set of companies that are, so data centers and AI infrastructure, huge build out from public companies even are spending tremendous amounts on CapEx. And because the thought is data, compute, hosting is going to be a major market if the world suddenly becomes, everything has AI. And we haven't even come to the wave of physical AI, real world AI. So I've heard companies pitching building data centers in space. And some of them are funded by really, really reputable peers. But if you think about it, data centers in space is like theoretically a really great idea, like infinite space, not in anyone's backyard. It's there's solar power for energy, and it's cooling, like it's cold. So that's one crazy like TAM that I heard where there's sticker shock to it, but then if you actually listen to the entrepreneur, I think that's why I love working with highly technical founders, because they come in with such awesome like frontier deep tech ideas. But that's certainly one crazy $1 trillion TAM idea that I've heard recently. And to your second question, I would say a good way, how I think about it is like product market fit kind of tells you if the product you have is hitting the right note in the TAM itself. It's not perfect, but I think for early stage companies, when you're experimenting and you want to figure out what actually works, we kind of always have this elusive, you've hit product market fit. I would say how I like to think about it is pipeline coverage is how I would try to quantify that product market fit. So if you have something and there's 10, 20 signups, or if you do open source and you're seeing your stars go up, that is a signal in and of itself that there's some sort of resonance there. It doesn't always mean you can monetize it, right? Again, back to product market fit, you want your product and be selling it into the market, but I think some signals on engagement in the market through some of this data is helpful in narrowing down whether you're in the right space. And then you can certainly build from there. I love that all founders have great ambitious visions to build this like platform company, but I really think everyone has to start somewhere. And then how I like to advise companies is you have that platform vision in mind, but you need to layer it on. It's a layer cake strategy. So you have your first act, you have your second act, and infra, again, OpenAI, Anthropic, and one of our portfolio companies certainly played that second act and third act and fourth act. They started by being model companies and developing models, and now you have agents on top of you, applications on top of it. So having the big vision is great, but I think very practically starting from a first wedge, getting in the market, getting those signals, pipeline, retention, engagement, and then building from there is probably a more practical way.
Hi, I'm Shapat, and we are building AI brain for humanoids.
Oh.
So we are a frontier tech company, and we are actually competing in the seed market where the agent builders apps have ARR. So what do you think that when we are building a company with a deep foundation model and frontier tech infrastructure, so how do we compete, and what should be our strategy in this market?
Yeah, I would say, and that's a really interesting question in that a lot of the model companies are now building apps.
Yep.
A lot of the apps, especially in vertical AI. So for instance, if you're in construction, maybe the general model is like not good enough to understand construction workflows or construction language. So you're fine tuning your own model or doing reinforcement learning to come up with a better model for your vertical AI company. So AI app companies are becoming infra companies are becoming app companies. I would say at the end of the day, it's like know what your team is, capabilities. What are you differentiated at? So if you're a highly technical, research-oriented team, maybe it's better to start from the infra side and then augment, your team with a product person or an app person to build out the workflows and the UI. So always kind of like, what capabilities are your team good at? What's the differentiator, what's the wedge, and then start from there. But I do think we're going to a world where everything is there's going to be more and more overlap. And again, back to the conversation about what is an app company, what is an infra company, what is an AI company.
Yeah.
I think we're going to see a world where you have these like massive labs that really do kind of everything, so to speak. And then app companies also will be fine-tuning and building their own kind of smaller, more efficient models.
Other questions? No one. Oh, one in the back. There we go.
Hi, this is Sunil. I'm from Scalable Technologies. We are based in San Jose. So what we're building is we're building finance agents for a lot of companies that are using ERP.
Yeah.
And we hear, companies like, Oracle or, Dynamics, they're trying to come with their own native. But I think the added advantage is the models are getting better and better. The technology is getting better. So that's where we have an added advantage. But what do you feel like from the perspective of, native versus coming in from, like for us, the strategy worked out because we have a history of, dealing with such, customers, and we're pushing it through the customer base. And one thing I found is a lot of the CFOs are very they're embracing AI like I haven't seen that before. They are the most cautious group. And so the question is, from the native versus, doing such a thing, I feel there is a big win, but I want to hear your thoughts and perspectives.
Yeah, I think goes back to AI native versus AI embedded. I will say this wave separate from the cloud wave or even mobile and internet. The incumbents, and I don't just mean public companies. Like I mean the lead SaaS leaders that maybe are still private, but are at scale. They're certainly not sleeping on the trend. And again, we're seeing really crazy triple-digit growth from both AI native as well as embedded AI companies. Some would say embedded AI companies, the incumbents, if you will, are at an advantage because they have the distribution advantage already being at scale. I tend to believe that. Again, seeing the numbers, like there really are some scaled SaaS companies that have now a second wave of growth through AI. I would certainly be more cautious in approaching highly competitive space with a strong incumbent in the space. And also in the public markets, like a lot of those large labs aren't sleeping again, or like a lot of the cloud companies and hyperscalers as well are not sleeping on this trend.
Yeah.
They recognize that there's huge market share at stake in this new kind of paradigm shift. So I still think that if you're a differentiated product, you have great customer love, great retention, AI native companies certainly have an advantage in that you're not kind of rejiggering your product, if you will. But certainly also the data definitely says that incumbents and AI embedded companies really will have a great shot at capturing market share.
Also means now is the moment.
Yeah, you gotta build
Because
quickly.
if you give them another 2 years, they'll be even further behind. Yeah, one more.
Yeah. Okay, so my question is about the fund allocation or thesis. So let's say a startup doing 3x, 2x, 2x is considered to be good in 2021, but in 2025 it's probably like average. So my question is, do you think theses now generally are more willing to, like when they see this type of company, they tend to wait until if they see a Supernova company or a Stellar company and put a bigger bet, a bolder bet on these companies and like trying to invest less in those like what we call good in 2021, the average in 2025. Thank you.
That's a great question. Again, every VC, even within Bessemer, I would say everyone has a different viewpoint on this. And it's back to the kind of discussion that we had on finding the VC that shares your philosophy. My view is that the power law in venture is so wild. So said another way, like the top, 20 companies will drive 80% of returns in our industry. And it always has been the case for the different waves from cloud to data infra to internet to mobile. And so losing out on partnering with that winner, if you will, and the large power law winner, the stakes are so high. You definitely want to, even if it's a very expensive price or very competitive deal, you want to be in the winner. And that's just my view. I think you can drive really great returns, kind of, backing companies that grow, give you 3x your return. That's a great hurdle from an investor's perspective. Everyone is different, but at least for me, I do think power law is so powerful that you want to be trying to get the 100x return and backing the winner, and losing that actually, to me, it's I think about the losses more than I think about the wins. And I think a very good investor, anyone who's self-aware in this industry, should not just be celebrating the wins. You need to be reflecting on your misses as well. And if you did miss a 100x returner, kind of ask yourself why, and like don't do it again, because the power law really is a tremendous kind of quirk in the VC industry.
VC self-criticism, self-therapy there. I would say that is definitely true. Power law exists, and it is perhaps only getting more powery. at the moment. However, this is where you as a founder need to differentiate both in terms of your strategy and their check size, right? You can have great returns from a very small fund if you are not OpenAI or have those returns. So it might mean that you need to adjust your strategy in terms of who you are pitching on the fund side. There are different ways to win in VC, but I think whether or not you can get kind of annoyed, like, well, they're only caring about the supernovas. Why is that? Well, it's because that most companies in VC fail. So of course, as the frontier companies push ahead further, that is going to raise the mental hurdle for everyone else. I don't think that's actually a bad thing.
No, and that's a great framework. So again, Bessemer in my context is where we're certainly a mega fund. We're on the larger side. And so, currently investing out of a venture fund that's close to $4 billion. So, backing a winner, driving returns on $4 billion, I think, makes the equation a little bit easier. But that's such a great framework of, again, knowing who you're pitching to, understanding what their kind of incentives are, and their philosophy will help you find the right fit.
I think we can take one more, Mandy. Was that sorry? He was in the back. Oh, okay. Fight. Okay, very good. Yeah.
Oh, close one. Hi, my name is Rudy. I had a bit of a more esoteric question for you. And there's a lot of people that suspect this is a bubble, and a very strong bubble, because the lines only go up and they only ever go up, and that can, of course, go on forever. So setting aside the data, setting aside all the research you've done, what does your intuition and your gut tell you about how close we are to that pop, and if it's going to be a very explosive one or a more gentle one?
I think that's, it's so hard because there are two things to balance. Again, we talked about power law. So there's huge FOMO in the industry. You do not want to miss the winner, because I say this with a lot of certainty that there will be at least one multi-trillion-dollar company that comes out of this wave, perhaps even multiple, and there certainly will be multiple decacorns that comes out of this wave. So there's FOMO that's kind of happening. But to your point about a bubble, yes, when seed rounds are post-money valuations with triple digits at the end for your first ever institutional raise, pre-revenue, pre-product, pre-team, like maybe not pre-founder, but like maybe only one founder in a way, that's all you're betting on. That, tells you something about the market is getting a little bit overheated. So that we try to balance the FOMO with a little bit of rationality. But certainly, that's why I kind of smiled at that chart, because there's certainly seed rounds going on now that have post-money valuations that were previously, back in SaaS days, like Series B kind of valuations.
Triple digits.
Exactly. And that's not a very healthy kind of dynamic. But again, the FOMO is just so strong now that as a VC, you don't want to miss backing like a great founder, going after a great market. So it's a little bit of a balance, but certainly there are signals that it's overheating a little bit.
I think we got 10 months. No, to be honest, there was a wave. I don't know if you all listened to it this week. There was a wave of podcasts, Dwarkesh, Invest Like the Best, et cetera, that was just digging deep on, Dylan Patel from Simi Analysis, et cetera, digging deep on how this bubble relates to the fiber build out, et cetera, et cetera. And it's so strange to hear everyone kind of agree. It's like, yeah, we're in a bubble. But the dynamics on an individual basis sort of dictate that everyone acts the way that they're acting. And of course, bubbles are good in the long term and bad when they pop, right? But like, we're using all the fiber that was built in the dot-com era. So is it this kind of bubble, or like, do GPUs appreciate so fast that we're actually not building that much in terms of structural asset advantage? I don't know, man. I give it 10 months. Yeah. In any case, let's give Janelle a round of applause. That was a wonderful first live podcast. Appreciate you all. I think we have a little bit more food and networking and stuff after this, but thank you so much for coming. We appreciate it.